Welcome back, and now we are going to talk about investment and more specifically about venture capital. First, let's see the definition of venture capital. It is money provided by investors to startup firms and small businesses with perceived long-term growth potential. So if there is an investor that wants to diversify their portfolio, instead of investing in stocks from large existing companies which have a limited potential of growth, they decide to take risks and invest in smaller businesses. This is a very important source of funding for startups that do not have access to capital markets. It typically entails high risk for the investor, but it has a potential for above average returns, and this is what we are going to see soon with the example from Facebook. Venture capital can also include managerial and technical expertise. Most venture capital comes from a group of wealthy investors, and wealthy means very, very rich, investment banks, and other financial institutions that pool such investments or partnerships. So sometimes a company needs more capital to take off than one single investor or one single investment bank is willing to risk. Therefore, they create a pool, joining wealthy individuals, investment banks, and other institutions that would like to invest in this startup. This form of raising capital is popular among new companies or ventures with limited operating history. It happened with Uber, it happened with Airbnb, and basically all very famous companies that you know, which cannot raise funds by issuing debt. The downside for entrepreneurs is that venture capitalists usually get a say in company decisions, in addition to the portion of the equity. When you don't have any investor from outside the company, you can make your own decisions. As soon as you have other people investing in your company, you need to listen to them, you need to consider their saying in basically everything that you do. How does a venture capitalist decides where to invest? Typically, venture capitalists decide which companies to invest in by reviewing hundreds of business plans, meeting entrepreneurs and company managers, and performing extensive due diligence on investment candidates. They are very selective because they are seeking opportunities in which their investments will grow rapidly and provide a successful exit within a certain time frame. When they do make a decision to invest, venture capital firms typically purchase a company's preferred stock and or lend money to that company. So they're going to perform an extensive analysis of the company and its owners or managers in order to decide if this company is worth their money. Something very important when we talk about venture capital is the exit strategy, because when a venture capitalist invests in one company, he or she doesn't want to stay in this company forever. They want this company to grow, and then they want to sell the equity that they own from this company. Therefore, with all investment, there is always an exit strategy. Let's see the definition here. It is the method by which a venture capitalist or business owner intends to get out of an investment that he or she has made in the past. In other words, the exit strategy is a way of cashing out an investment. Examples include an initial public offering, an IPO as we had seen, or being bought by a larger player in the industry, also referred as harvest strategy or liquidity event. Because one of the alternatives is if you create a company that borders a very large player in a specific market, there is a trend that this largest player will acquire your company. So this is an important exit strategy. Continuing. It is more difficult for a VC or entrepreneur to get money out of an investment because they are generally dealing with private companies. When a firm is private, the shares cannot be sold nearly as easily as when the firm is publicly traded on a stock exchange. So, even though a private startup firm could be worth millions of dollars, the VC entrepreneur has little access to this wealth. You can think of the exit strategy as the first opportunity to trade any liquid assets, shares in a private firm, for a very liquid asset, that is, cash. So this means that sometimes even if a company becomes very big and very successful as Uber, the owners and the investors, they will only make money if they are able to sell part of their shares. And it's only possible if the company is acquired, but it's not an easy scenario to happen, or during an IPO, because then they will be issuing their shares in the stock market. This is a case study of how Facebook was funded. And start here with me in the bottom of your screen, where I'm with the mouse F. This is the first investment that Facebook had received, $500,000 from an angel investor. An angel investor is a very rich individual. In this case, it came from Peter Thiel and Reid Hoffman. So this is also called seed round. So it's the first investment that Facebook received, and it was in exchange for 10.2% of the company. So even in 2004, in the very beginning of Facebook, its market value or the company valuation was around $5 million. And then you start having many different rounds with a much heavier investment from other companies, investment funds, etc. So you see here Series A, it's the first round after the seed round. They received 12.7 million. In a second one, 27.5. In a third one, 240 million from Microsoft. I guess few people knew about it. The Microsoft also invested in Facebook. And then 60 million from Li Ka-shing, one of the most wealthy individuals from Hong Kong. And then other rounds of investments, until we have here debt financing, 100 million, another investment of $200 million, and then a private equity investment of $210 million, and a final one of $1.5 billion from Goldman Sachs and Digital Sky Technologies. So in total, Facebook had 11 funding rounds, raising $2.4 billion. And now I'm going to tell you a story about what happened with Peter Thiel. That was the angel investor, the first person to invest in Facebook. And as I mentioned, he invested $500,000 in exchange for 10.2% of the company. So, to finalize, I'd like to tell you a story about Facebook's funding. In 2004, a guy named Peter Thiel invested $500,000 in Facebook in exchange for 10.2% of the shares, okay? So he was the first investor, what we had seen in the seed round, 500,000 for, let's say, 10% of the company, a valuation of $5 million. Initially, one of Mark Zuckerberg's partner slash advisor, a guy called Sean Parker, introduced Mark Zuckerberg to Reid Hoffman. Reid Hoffman was at the time the founder and CEO of LinkedIn. Okay, so he presented them because he thought Hoffman might be interested in funding Facebook. Hoffman found that it was an interesting idea. He was interested, but he thought that there would be a conflict of interest because LinkedIn is a social media as well. It's a professional one, but anyway, he preferred to decline. But he said there's a friend of mine that will probably be interested in investing, and this guy was Peter Thiel. Okay, and the two of them, Hoffman and Peter Thiel, had worked together when they started PayPal. There's another very successful company that I believe that everybody knows. But where I want to get is Peter Thiel invested $500,000 for 10% of the shares. When Facebook filed for an IPO, an initial public offering, he was able to sell some of his shares. And after all the other rounds and all the valuation and all the value that Facebook had gained because of the traction, because of the number of users that increased exponentially, he sold his shares for $638 million, part of his shares for $638 million. And after some time, he was allowed to sell another part for more $395 million. So in total, more than $1 billion. So with a $500,000 investment, he made $1 billion using the exit strategy as we have seen before. So of course he invested at a certain time. He wanted to recover his investment selling part of his shares. So he made a fantastic deal. It's much better than winning the lottery. We are talking about $1 billion out of a 500k investment. So it's one of the most successful funding histories in the world. So this is the end of the English for Finance course. I would like to thank you for your participation and your efforts completing this course. I hope you have gained a lot of new vocabulary and knowledge in the finance area, more specifically regarding the English language. Remember, it's always important to keep reading and keep studying, keep watching videos related to our area in order to gain vocabulary. One of the most interesting TV shows that use a lot of finance vocabulary and is related to venture capital is the American version of Shark Tank. So I really stimulate you to look for it on YouTube or in cable TV if you have this channel, because it's a very interesting way to build vocabulary. And I will keep you informed about other courses in your professional field, and I hope to see you in one of our future courses. If you have any question, don't hesitate to contact me. You know my email by now. So once again, thank you very much, and I hope to see you soon.